Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn futures has managed to break out of its previous trading range that it's been in for quite some time and has now moved up back inside of the higher trading range within which it was in. The lows right now appear to be around the 357 area, and the potential highs are sitting at about 374.5. This again is the same trading range upon which it was in before, and the market has been tracing up very nicely against our 2x1 angle. We had been looking for the market to make a nice move to the downside, and over the last 4 to 5 trading days it has been range bound. It made a very nice high last week, and we thought the market could very well make a breakout to the downside, but instead we've seen a sideways congestion that has been tracing up against our 2x1 angle. Upon breaking this 2x1 angle, we still believe that this market can make a move to the downside, although we are running out of time for the March contract since first notice is only about a week and a half away. We can see where the top on February 8th did come in very close to our time factor, and in doing so the market did give us a nice move to the downside. But instead of becoming a new trend to the downside, instead what we have found is that the market has been range bound and is finding very good resistance along our 270-degree mark at 366. We'll continue to monitor this level, and upon breaking back below this 366 number, we think that could very well be a signal for a nice little pullback as the market makes its way off the board. The next important time horizon that we have for the May contract is on February 20th, and we anticipate that this market could very well continue to just simply trade sideways coming into that timeline, and at which point we can see a potential move to the downside. We do have overhead resistance if the market's able to make its way a little bit higher at about 380, but getting beyond 380 looks like it should be very difficult, at which point we'd be looking for the May contract to finally give us a decent correction. Downside support then looks to be somewhere in the neighborhood of 363 to 365, and the market probably won't get much lower than 360 in general, and then from there we can see a potential bounce back up to the upside. The next key level of resistance for the May contract sits at 383.5, which is 1 standard deviation below the point of control, and that is very much in conjunction with had been previous resistance prior for this contract, now that it is trading back inside of the prior trading range. March soybeans is giving us exactly what we've been looking for. We took a measurement of the previous low up through the high and then took some measurements from there to give us a correspondence as to where the market can potentially go. Measuring from that low at 967 3/4, we have a 1-to-1 correspondence at 1028, and the market is essentially trading right up against that minimum price objective that we've been looking for. If this market's able to get to 1044 in the not too distant future, we're looking at a very strong move in soybean, and it could very well continue higher. From here, we can see the way in which this market has been tracing along our arc swing very nicely. And you can see the price action and the steepness of the move has been directly in correlation with that projected swing. Once this market either makes it to about 1028 or 1024, we anticipate a bit of a pullback and for the market to be soft, and perhaps the market can finally stall as it approaches the next time factor that we can see on the chart. If you recall previously, we talked about how 975 was a key line in the sand level for this contract. We saw a pullback that came down to our 90-degree mark at 968.5, and upon reaching there, the market gave us a very small pullback right up against that 979 number and has been in a very nice trajectory to the upside. We're now up against our minimum price objective that ranged somewhere between 1027 to 1031. And upon making it to this level, it appears that the market will have reached volatility-based resistance overhead, and we think that the market could potentially pause somewhere in the neighborhood of 1027 again to 1031. 2 standard deviations beyond the point of control rests at 1035. So in the event that the market's actually able to make it up to that 1035 number, this would be a very good number for this market to really find a key pullback to finally put a stall on this move that we've been seeing to the upside. July beans is moving in a similar fashion with the minimum price objective sitting at 1048 3/4. And we do have a time factor coming in on February 20th for this contract as well. If the market's able to blow through this 1049.75 number, the next key level that we'd be looking to is at 1065. And if the market gives us a number of closes above this 1065 number, we really believe that a very nice vault to the upside could very well be ahead for beans. The move in beans today is effectively a retest of previous major highs coming in near that 1045 mark. And once the market gets through here, once again, we think that we should at least marginally break a little bit higher and reach up against maybe the 1050 number for this contract. We do have volatility-based resistance setting up overhead, but we do have the second band also that's making a shift to the downside as well. So again, that 1065 to 1050 number looks like a very good area for this market to potentially pause. And from there, we can see a small correction before it looks to turn back up again. Long term for the July contract, we do believe that getting up to about 1080 at a minimum is plausible, and we have long been sharing about our price target objective of about 1100, and looks like the market is very well on its way to making its way up there. March wheat has made it to our minimum price objective of 466.25, and upon reaching there, the market has now come back down, but we can see a little bit of strength still coming in for the market here. The market now is very much at key levels, and we can see a very nice consolidation over the past week to about week and a half. And upon being able to break above this 466.25 number, we could see some legs ahead. But for now, we anticipate a bit of a softness in the week contract coming in. The market's made it to where we've been looking for it to go, and with a nice move to the upside that has been at a very nice target, and a correction coming back to about 437 to 438 would not be unrealistic. From here, we simply want to continue to monitor the way in which we trade. But since it's made it to our key price objective, if we have already been long this contract, adjusting stops tighter or coming out at these levels is reasonable. But at the very least, we do want to protect profits and adjust stops below where the market's trading. And perhaps having a stop right underneath today's low could very well be a nice spot to be able to trail this market higher. It has moved into overbought territory, but a market that is inside of overbought territory simply means that if the market does not correct, that the trend would change to an uptrend and could very well find continued strength and move its way up. We can see that part of the reason why the market may have stalled at the 466.25 number is that we have a 180-degree factor coming in. And again, if the market's able to break through, the next price objective then would be about 488 for a nice target. We also have one of our natural sinusoidal waves overhead as good resistance. So the way in which the market closes this week will be very important to tell us whether or not it's able to sustain the prices upon which it's at right now. It is trading right up against volatility-based resistance overhead. So there are some key factors that could potentially make it a little bit of a struggle for this market to get much higher. Last week, we shared that the US dollar could very well find some trouble in the neighborhood of $90 to $91, and that's exactly what's been occurring all week. And with the market coming back down again, we can potentially see some continued strength in the commodity sector. Right now, our downside target for the dollar index looks to be somewhere in the neighborhood of $88 to $87. And that's exactly what it's given us after this nice little shallow pullback that we had been looking at from last week. With the market now having fallen from resistance, we're looking for the dollar to continue lower. And as we look at the longer term time frame, we do think that the US dollar continues to be in jeopardy of finding continued weakness for some time to come. Taking a look at the weekly chart, we can see how already in just these 4 days of this week, the market has given back all of the gains from the prior 2 weeks. And now with this downside move that we're seeing, the likelihood of the market coming down to about 87 is more probable. And that would be the next area that we would look for a potential target to see if the US dollar can at least hold for a couple of weeks. Breaking below this 87 mark simply tells us that the market has more to go in the near term. And we'll simply continue to monitor the way in which this US dollar continues to trade over the coming weeks. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next time.